Hi, I'm Linda Eedes from Foord Asset Management, and I'm here today with my colleagues, Rashaad, Tayob, and Farzana Bayat. Now, Rashaad and Farzana are both portfolio managers for our fixed income funds and also contribute to the macroeconomic strategy. As you know, Foord does have a top-down element to its investment process, which is where your input is very valuable. Today, we're going to be talking about inflation-linked bonds. Now, of course, inflation in South Africa has come back to the 3 to 6% band, but we have seen other emerging markets, such as Turkey, having hyperinflation. So one of the things we're going to talk about today is where inflation-linked bonds would play a role if we saw a situation such as that in South Africa. But before we get there, Farzana, can you first briefly explain what an inflation-linked bond actually is?
Sure, Linda. So, nominal bonds are bonds that have been issued for many, many years. And inflation-linked bonds are a fairly new asset class. And the main difference between the two, so a nominal bond, your principal basically stays the same. So if a bond is issued at R1,000,000, in 10 years' time, you get paid back your R1,000,000. Your principal is flat. But an inflation-linked bond, your principal actually increases by inflation every year. So if your bond starts off at R1,000,000 and inflation is 10%, the next year it goes to 1.1 million, and it carries on until year 10, where you get paid the full inflation over that period. And in that way, an inflation-linked bond actually guarantees you inflation return.
Now, Rashaad, why would governments actually want to issue inflation-linked bonds in the first place?
That's a good question. I mean, governments have issued nominal bonds for centuries, and often they run high levels of inflation in order to reduce the real value of their debt. But you can't do that with an inflation-linked bond because, as Farzana explained, the inflation-linked bond is increasing, the principal is increasing with inflation. But the thing about it is that an inflation-linked bond has a lower coupon than a nominal bond. So inflation-linked bonds in South Africa have coupons around 3%, and it's only that 3% that goes into the cost of debt. The cost of debt is the coupon, but it's also the increase in principal. And that's if inflation is 5 or 10%, that's a significant cost, which is not included in the cost of debt. At the moment, South Africa's cost of debt is about 21% of our revenues. It's a very high number. It's doubled in the last decade. But if we were to include the inflation component and that increase in principal, it would be closer to 24%. So issuing inflation-linked bonds at lower coupons helps to optically lower the cost of debt. And I think that's why it's attractive for governments to issue them.
Okay, now is there a diversification benefit to holding inflation-linked bonds in a portfolio in addition to nominal bonds?
So if you look at the return history here or in the US, for example, over the last 2 decades, you haven't really seen any performance benefits, any return gain by having inflation linkers versus nominals. So you haven't got a return benefit. And then they've performed very much in line. The correlations have been quite high. So you haven't really seen a diversification benefit yet. But I think when you're thinking about diversification in terms of portfolio construction, it's important to go beyond just historical data and understand the key drivers of return of an asset class. And when you look at those key drivers, inflation is a very big driver, a positive driver for the return of inflation-linked bonds and a very big negative driver for the return of nominal bonds. So in that way, you can see a very important diversification benefit, but in periods of elevated inflation. And for a lot of the world, we haven't seen that yet.
Now, talking to that, we have seen quite an inflation spike. It's sort of trending lower now, but certainly globally and locally, of course, following all the stimulus and low interest rates, we did see quite an inflation spike. And yet, am I correct in saying that inflation-linked bonds actually underperformed? Farzana, I want to bring it back to you. Why did that happen?
So Linda, when you look at a total return of an inflation-linked bond, it's made up of 2 components. It's the change in the real yield as well as inflation. So you're right, over that period, inflation did go up and it was sort of 9-10% in the US, but the change in yield was massive. You know, for example, in the US, the real yield went up by 3%, from -1% all the way to 3%. And that capital impact more than offset the increase in inflation. And just to remind you, when real yields or when yields go up, the price of your bond falls and you actually lose money. So yes, investors did lose money in that period, but we believe that now that real yields have re-rated significantly, both locally and globally, we think at this point on, the risk reward is very attractive. And the prospects for future potential returns on this asset class class is very attractive.
Okay, so your starting yield is a really important component.
It's very important, yes. And the starting yield was too low in that period, which is why investors lost money.
And I think part of the reason why the yield at the moment is high and why the sentiment is so poor is because linkers disappointed so severely. In a period where you'd expect an inflation-linked bond to deliver your best return and protect your capital, you actually lost capital in real terms. And I think that has soured investors against the asset class, and that's what's giving us the opportunity to buy them at attractive valuations.
Okay, so now Rashaad, if we think about going forwards, we are an emerging market. There is still a chance of inflation surprising on the upside over time. And I want to again bring back to that example of Turkey, which did see a hyperinflationary environment. What happened to inflation-linked bonds in that environment with that sort of rampant inflation as a backdrop?
I think Turkey is a very good example because they were running with inflation of around 5 to 10% for a number of years. And then with a very loose monetary policy, very low interest rates, a lot of stimulus, they ended up pushing inflation to very high levels where they were running around 70 to 80% inflation for about 3 years. And in fact, inflation as we speak now is still above 60%. So in that environment, when we look at what happened, inflation linkers actually managed to deliver you a positive real return of 6% per annum. So even in an environment where inflation had gone up 300% over that period, your inflation-linked bond actually protected the real value of your capital. The nominal bond, on the other hand, even where nominal bond yields were sitting at around the 15% level and stayed around that level, the problem is if you're getting 15%, it seems like a high number, but when inflation is 70 or 80%, you're losing a massive amount in real terms every year. And in fact, you wiped out 70% of the real value of your capital in Turkey over the last 3 years by having nominal bonds. So in that environment, inflation linkers actually saved your capital.
Okay, so I guess the obvious question to ask is that kind of runaway inflation even a possibility in South Africa? And Farzana, perhaps you can give us some of your ideas on that. Is that even a possibility that might happen here in South Africa? I mean, you mentioned 70, 80% inflation. That sounds terrifying. What are your thoughts on that?
Yeah, so Linda, at the moment, inflation is well under control in South Africa. We think the SARB has done a very good job. But where we do see risk of higher inflation coming is from the significant debt burden that we see in South Africa. We all know that South Africa has a debt problem. Our debt levels have gone from under R1 trillion in 2010 to now well above 5 trillion, heading towards 6 trillion. And we see no signs of that abating as we continue to run with very high fiscal deficits of 5 to 6%. We're having to fund those at increasingly higher and higher interest rates. In fact, when you look at our interest cost, Rashaad mentioned that we're sitting at 20-25%. That means for every 100 Rand of revenue that we get, 20 to 25 Rand is being spent on interest costs. That is clearly unsustainable. So what are our options to stabilize that debt? So if you look at the debt to GDP formula, if you want your debt to GDP to fall, you need your denominator to go up. That means you need your GDP to go up. And GDP will go up either via real growth or via inflation. Now, if you think about growth in South Africa over the past decade, it's been sub 1%. And without any meaningful structural reform or policy shifts, it's likely we muddle along and continue along the same trajectory. So all that means is that the easiest way for us to reduce the debt is to run with a higher level of inflation. So this is not something the current SARB team subscribes to, but we know that the political future in South Africa is uncertain. And we also know that it's the president that appoints the SARB governor and deputy governor. And in the coming years, we could sit with a different president, we could sit with a very different SARB team who might be more amenable to running with a much higher level of inflation in order to stabilize the debt.
Okay, so it sounds like there's a reason for being in terms of having linkers in the portfolio. Can you speak a little bit to that? What is the value that inflation-linked bonds bring within the portfolio context?
So inflation-linked bonds have two invaluable features that make them a very valuable asset class in any multi-asset fund. One, they're the only asset that gives you a guaranteed risk-free real return. And two, they're one of the few asset classes that give you an asymmetric payoff profile, which means that your downside is limited. So what this means is that if inflation is very high, then as Rashaad mentioned, like in the case of Turkey, then your linkers will do very well. But in a case where inflation is very low, your downside is pretty much limited to cash. And what we mean by that is, say for example, inflation is at the lower end of 4%. 2%. And I think that's what investors worry about with linkers. So if inflation is 4 and your real is 5, it gets you to 9%, which is in line with cash. But in that scenario, you'll have the SARB cutting rates, you'll have that real yield come down, and that capital impact will feed through, which means that your linkers could actually deliver better than cash, even in a low inflation scenario. So we just want to highlight that nominals and linkers behave very differently in different inflation scenarios, and linkers definitely give you a lot more downside protection. They have been an underappreciated asset class because real yields in South Africa have basically been going up over the past decade, so they haven't delivered very good returns. But we think that given that yields have re-rated to where they are, the prospects from this point forward are very attractive.
And so it goes without saying, I would imagine that we are using inflation-linked bonds both locally and globally.
Yes, for sure. Across our portfolios, across all our multi-asset portfolios, we have been building an allocation to inflation-linked bonds. And in portfolios where we can have offshore exposure, we have exposure to US inflation-linked bonds, which are called TIPS. And there we've been buying more shorter-dated ones, and we've been buying at real yields of above 2%. And in the US, the market's pricing in break-even inflation to be around 2%, even though inflation has been sticky at a much higher level. So we think it's a really good asset class to be in because you can get the full upside if inflation stays sticky in the US.
So as long as that inflation turns out to be higher than 2% is what you're saying, inflation linkers make sense.
Exactly.
Now, Rashaad, you guys have made a very compelling case for inflation-linked bonds. If you can get sort of a 4% real yield from inflation-linked bonds, why would you even bother with other asset classes? Why not just hold a portfolio of inflation-linked bonds and go on holiday?
I think when it comes to looking at portfolio construction, we don't believe in putting all your eggs in one basket. I think you get a lot of diversification benefit from holding a range of asset classes. And if we look at the valuation of South African equities, for example, the level at which local equities are valued at the moment means the prospective returns are higher. And I know some of our equity fund managers would argue that they're higher than CPI plus 4, which is what we're getting on shorter term inflation-linked bonds. So I think there is a case for holding equities and the potentially higher returns there, but we still think that the risk return on inflation-linked bonds is very attractive at these levels.
But having said that, we do believe that short-dated linkers at these current elevated real yields do offer great risk-return characteristics, and we think investors are underinvested in this asset class because of the muted historic performance. But we see value, and across all our multi-asset portfolios, we have a decent allocation to this asset class. And in fact, we are busy launching an inflation-linked income fund that investors can use as a building block in their multi-asset funds to get exposure to short-duration inflation-linked assets. And the main difference between how this fund will be different from a traditional inflation-linked bond fund is the duration will be limited to 2 to 3 years versus a traditional linker fund where your duration would be much longer, like 10 to 11 years, in line with the inflation-linked bond index. And we believe that by limiting the duration, it will limit the volatility in the fund and give us greater predictability of achieving that inflation plus return. So on a year-to-year basis, you are much more likely to see a proper CPI plus return versus your traditional inflation-linked bond fund where your returns tend to vary quite a lot because you're sitting with a much higher duration. So we think it's a type of fund that investors haven't had an opportunity to invest in because they've been constrained by inflation-linked bond funds that have a very long duration. And we think it's a very good building block for any multi-asset portfolio.
Okay, great. Well, we'll keep an eye out for further developments. Thanks, Rashaad and Farzana, for your contributions today. And thank you to everyone who's joined us for this discussion.